Welcome once again, friends. So we're still doing audit of assets. So we've looked at assets audits in the past, in the previous section, where we're looking at the tangible and then the intangible. So we look at verification of assets, the PPE, okay, the ones we could touch, the tangible ones. And then we looked at the intangible, centered more on the IAS 38, research and development cost and patents and then copyrights and licenses and franchises. We want to move on to do more of auditing of assets. Like I said, it's a significant component of audits and it's an area you can dwell on, even on the field work. Once they give you asset auditing, that could be your only work on the team throughout the period of the audit assignment. So we want to move on to that segment. We look at the cash and bank, we look at receivables, we look at inventory, IAS2, then we wrap up over there. Okay, so I share my screen and then we kickstart. Okay, so the same learning objectives as previously, but like I said, we want to focus more on the other aspects of inventory assets that we've not covered. So same here, we're looking at audit of current assets. In the previous unit, we looked at audit of the intangible and tangible assets. Here we're looking at audit of current assets. Okay, so we'll be looking at the bullet point from inventory and work in progress, receivables, cash, and bank. Okay, and then we'll look at legal consequences if we fail to do that. From our history or from our understanding in accounting, we know what inventory and WIPs comprise. So our consumables, raw materials, WIPs, finished goods, and then payments on account. Okay, so payment on account, you say, how could this be an asset? It is more like a prepayment. Let me put it that way. It's more like a prepayment because you've paid ahead of time, anticipating that it will cover some transactions or activities yet to unfold. Okay, so we'll consider it that way. Now, we all understand the auditor's response to assess risk. ISA 330. Okay, so within this particular segment, we need to also consider the business risk, okay, of affecting the company. Now, the company could encounter some business risks, operational difficulties, if inventories are too high. If inventories are too high, what we are saying is that we are overproducing, we are buying more from suppliers, we are not selling. We are not selling. So what is happening is that our cash is locked up in this high level of inventory, which is not too good for us. It poses a business risk to the company. Again, when inventory is too low, we may not be able to meet demands from suppliers, from customers. Okay, so customers may be requiring this particular product and we don't have the resources, the materials to produce or to supply them with these goods and services. That means that we could be losing out and competitors could be taking up all our customers. Again, it poses business risk. So we want to at least be at the optimum level, okay, where we will not be too low on inventory and not too high on inventory. So as an auditor, when you are going into audit, there are some specific risks you should be looking out for. There could be poor recording, maybe understating or overstating inventory for some good reasons. People would always want to hide something, okay? Did I say good reason? For some good reasons on their part, but to us, it may not be good reasons. There could be poor storage, loss or damage to the goods or inventory. People could steal, pilferage could also occur, okay? They could steal these items, theft could happen. Inappropriate write-offs of bad debts, of solid inventories could also occur. And also check, are there third-party inventories which may have been included in our inventory, in the client's inventory? Okay, they want to overstate it. And so if there are some third-party inventories which needs not be included, they could include it. And again, they could deliberately falsify the values of these inventories for fraudulent purposes. People want to always overstate their assets to look good, so that when you want to invest, you know that, yes, the company has some good resource base, asset base. So they could deliberately falsify the account. ISA 501, audit evidence. There are some specific considerations we would want to look out for on selected items. Now, if you realize that the inventory is so material and significant to the financial statements, then it is always important that the auditor would obtain sufficient appropriate evidence regarding the existence of these raw materials or inventory and regarding the condition. So it means we need to attend physical inventory counts, unless it's not practical to attend. Okay, and I remember one of our auditors, I'll not mention the name of the clients, their inventory alone was the next highest item on their balance sheet. And so we spend so much time, almost about 50% of the audit time on inventory, going for stock count and then checking everything is in place. So inventory, once it's material, be careful, you have to spend a great deal of time on it. I've been on an audit where at the end of the audit, the inventory manager, the senior inventory manager was sacked immediately because there was so much irregularities surrounding the inventory and he was sacked. It was quite a reputable job, very good job, very good position. So we attend these inventory counts to evaluate management's instructions and their procedures regarding inventory recording and physical control over the inventory. Is it okay? Are they doing well? Their procedures, is it okay to record this? And do they have very reasonable policies and procedures on how to physically safeguard these assets? Again, we attend these inventory counts to observe how management perform their inventory counts. Want to observe. And we also partake in it. We test count some of them. Okay, not everything, but we test count. And want to also inspect whether there are some obsolete inventories which have been included in the inventory. Once it's obsolete, you need to write it off. Okay, so we attend inventory on those notes. Again, let's continue still on the same ISA 501 on audit evidence, where auditors must also perform audit procedures over the entity's final inventory records. The idea is we want to determine whether their records actually reflect the inventory count results. Now, if inventory counts are conducted at a date other than the year end, mostly inventory counts will be counted or observed at the year end. But what if they do it prior to the year end? It means as an auditor, we must obtain reasons why they are doing that. Maybe they do it on a rolling basis. It's not because of our audit. They used to do it. Obtain the reasoning behind it. But again, we must also obtain audit evidence about the changes in inventory between the count date and the financial year end date. Is there any changes within that period? And then if we need to adjust, we adjust. Okay. Now at inventory counts, whether at the year end or throughout the period, if it is on a rolling basis, we must ensure all items are counted. In fact, all significant items, material items are counted. And again, all material items are inspected to look at their conditions. We've gone on audit counts where we have to count bolts and nuts, and we have to count nails for building, I mean. It was something I think, why am I counting all this? Okay, but you have to inspect and count that they are in good condition. Now, we also have to look at inventory records. We must reconcile them to the count sheets. Like I said, if there's any discrepancies, call for adjustments. And again, normally when we go to observe these inventory counts or we go and participate in these inventory counts, the individuals who are in charge of recording the inventory should not take part in the counting. We want an independent person altogether coming in to guide us through, because the risk is that if care is not taken, they could hide things from us, which we may not know. They have been in the system for long. But again, the one who is coming to assist or to help with the counting should know where to locate the inventories. Otherwise, you end up doing a long work without any good results. We must always plan when going for the inventory counts. First, what happened last year? Review prior year records. Where did they go for the counting? The nature of the counts, which was done, the volume, and the procedures that the client produced or give to them. You would have a copy on file on your prior year working papers. Check them. Was there any particular problem areas? Note it down so that when you go on the field, you could also follow up on similar areas. Check, are there enough risk controls over the inventory records or inventory management? or there are no controls at all. If there are not, check the inherent risk associated with it. If there are controls, check the control risk, whether the controls are working well. Okay. Now, arrange for any third-party confirmations. Sometimes we have inventories we leave with third parties. So the company will have inventories they send out to other people. When we are counting their premises, the inventory on their premises, we need to include a third-party inventory, and we need to arrange for that as well. There could be specialized items or some unique items which we auditors cannot detect or count or value. In that case, we need an expert valuer on board who would help us to accurately value these. Now, once again, check the client's count instructions on your file. Is it adequate? Do we have to amend it? Of course, auditors will always have their audit methodology. Yes, audit methodology. That helps them in counting these inventories. Reconcile it with that of the clients and see where you have to do extra work or where you have to maintain the status quo. Now, all inventories must be counted in line with the client's written instructions and in line with our audit methodology. Like I said, get specialist knowledge for items which you think will require a specialist valuer. When items have been counted, mark them to show that it has been counted. Of course, make sure you mark them with something which is not indelible, something which could be clean so that it doesn't distort the client's records after you've left. Also, when we are counting, we always have a count form or count sheet. Make sure it is pre-numbered, sequentially pre-numbered, to ensure that you've included everything that needs to be counted. The idea is that we don't want to haphazardly be counting things, but want to follow a sequential logical approach. When counting, make sure items are not being moved out of the stores into the showroom. No, items should be stagnant until we have finished all the counting or observed all the counting before we move items. During the count, like I said, you have a count sheet and you have the inventory there. So you could count from the inventory records to the count sheet or from the count sheet to the inventory. When the company that you are auditing has a rolling system where they keep counting every now and then or regularly, every quarter, every 4 months, 3 months, it means we don't have to attend only one stock count. We need to attend several stock counts. Check any obsolete or damaged items, and if possible, let them know that this should be taken out of the total value of inventories. There are instances where the client's procedures are not followed. Ask why. Ask why and note it down. Ensure that all the count sheets have been returned. Keep a copy on file. Anyone who goes on the client counting inventory count should return the items back so that you keep this on file and use it for your valuation. If there's been dispatch outwards, check the records of the last delivery of goods which we received, which the client received, okay? And then what was dispatched. Check those for cut-off purposes so that we don't include things we are not supposed to include and we don't take out things we are not supposed to take out. Ensure that there are no third-party goods included in the client's stock records. And always initial the test count. So you finish counting, you must show your initial on the test count sheet. Okay, so Richard K. Kojotevia, we normally put RKT so that we know that bolts and nuts were counted by Richard Tevia. Inventory counts, the cutoff. So during the count, note that, like I said, the last date of delivery notes and dispatch notes so that we don't include things we are not supposed to include for year-end values, and we are not supposed to take out things we are supposed to take out. Okay, so make sure you include what is included and you take out what is to be taken out. The idea is that we want to ensure goods sold but not dispatched are not included in sales and receivables as well as in inventory. Okay, so once it has been sold but not dispatched, it should be taken out. It should be taken out. Okay. Check the sales, check the inventory to the sales and purchases records before the year end and after the year end. Sometimes people want to play smart at the year end and adjust things. Okay. When valuing in our system here, we always want the first in, first out, but there could be weighted average. Some clients' policies means they have to value the inventory using weighted average method. Some could also use last in, first out. Okay, so maybe they bought the final goods or inventory or raw materials from the suppliers and realized this one will go obsolete quicker than the old stock. So they want to sell the last item which came in first. So either way, look at the policy of the company and the reason behind the valuation method they are using. Okay. Check what costs have been included in the raw materials. For example, are they including the freight charges, the taxes on them, the import duties, any delivery charges? Check whether it is included. Are we using standard cost or actual cost? You would have remembered this from your experience or studies, previous studies in management accounting. So check if it is standard cost or actual cost. Trace it to the purchases invoice and then check inventory records for any slow-moving items. Why? Okay, and follow up on any discrepancies you note to us during the inventory count. IAS 2 on inventories will give us other dimensions, so we must always understand the accounting principles underlying IAS 2 for raw materials, finished goods, and work in progress. Now, for finished goods, check inclusion of overheads. People can be smart. Okay, so check, are we using the full cost basis or we are using the partial item where production overheads may have to be excluded and reported differently. Check inventory items with sales values to ensure that they are not below the net realizable value in the case where sales less the disposal cost would be factored in the analysis. And again, once again, slow-moving items, check and know their values. Check the points from counting regarding damaged inventory, get them out, damaged inventory, make allowances for them, and charge it against your cost of sales as we would have known from previous studies. Check items which may be sold off cheaply or heavily discounted. Why? Is it because it is nearing its expiration date? Discuss with the sales manager and management and let them explain the reasoning and get some documentary evidence to support that. Follow up on valuation of returns, items which have been returned. Check customer complaints. Some customers will complain about some inventory lines, and check the net realizable value estimate. Is there a ready market that can help us understand how they came about the sales amount or sales figure, and then the disposal cost, to be able to identify that or to ascertain the accuracy of our net realizable value estimates, which we have on file. There are some WIPs which could take long to complete. So check what is included. Production overheads, is it reasonable? Are we using full cost basis? The stages of completion, measure them accurately and estimate work done to be completed. Review the progress of contract against documentation, including original contract, check for any penalty payments, and ensure that all valuations are done by qualified persons. This brings to bear the IAS on revenue from contracts from customers, okay? And this one, I'm not going to go into that in IFRS 15. I'm not going into that one now. So just simply make sure that if the item has to be completed in stages, are we crediting each stage with the correct revenue, and are we charging the inventory accordingly? Okay. Review cost to date, cost to complete, and then the contract price to identify any losses, and we must recognize this in the account. Any profits we have realized from the contract, review the calculation and take into account if the calculation made is correct. And once again, make sure this is in line with all the relevant accounting policies and principles of the company. Again, I mentioned this IFRS 15 for construction contract revenues. You always have some inventories associated with this. Now, recognize these revenues in the accounting period. Make sure it relates to the accounting period, work done within the accounting period, both the cost and the revenue associated with that particular accounting period. Usually, when the costs exceed the revenues, expense them off immediately. Check, did they do that? Costs relating to future period, future WIPs. We can recognize these ones only if we know that we can recover these costs later on. if we can't write them off. Now, so identify once again the revenue and the cost and ensure they relate to the correct accounting period. Ensure any costs we have carried forward, like I said, are recoverable. If not, write them off. Standard costing, you would have, like I said, seen this in your previous studies in management accounting. So check whether we are using standard costing. IS2 allows standard cost to be used, especially when prices are not stagnant, are not fixed. They keep changing. In that case, we want to get a cost value which is quite close to the actual cost. So we use standard cost. In this case, auditors must establish if the standard cost is reasonable, if it is appropriate, is it really fluctuating, or it is fixed and somebody is trying to make it fluctuating. In this case, speak to the management, let them explain. Use price indices you could identify on the market, on online, reputable online sources, and establish if this standard cost you are using is reasonable. Discuss with management. Now compare what has been done this year with what was done previous year. Was standard cost used last year, or was actual cost used? And why the changes, if there has been any changes? And check whether this, again, is in line with accounting policy and has been fully disclosed by the organization. Checking auditing standard costs can be a bit complicated if you are not too good with standard costing and the management accounting, but we need it. Now check the calculation of the standard cost. Look at how reasonable it is. Compare it to previous year. Look out for the individual elements that goes into the standard cost against the actual records. So like standard labor cost, look at the payroll figure and look at the hourly rate, okay? Look at any variations in the management accounting so far as this standard costing is concerned, and follow up on any variances that pop out. It will always be important to carry out some analytical reviews and substantive testing in that regard. We know receivables, right? Prepayments are part of receivables. We must always verify these. Control account reconciliation of the receivables are normally done automatically because today we have various softwares which will automatically do the reconciliation for us. But we must also review the sales. We must also review the sales to check whether it jives with the receivables. Because whenever you sell, two things come up. Either you get cash or you get cash later. Now, if you're going to be getting cash later, it results in what? Receivables. So also balance the checks. Balance the checks to the sales ledger. So checking the sales ledger, the nominal ledger figures, to the checks which have been received from the receivables. So check whether it matches up. It is always important to also undertake agent analysis to know receivables or debtors who are owing us in less than 30 days, between 30 to 60 days, between 60 to 90 days, those who are owing us over 120 days. It helps us to make provision or allowances for doubtful debts. Okay, so always do an agent analysis. And once again, these are done normally automatic. If you pop in the figures in the data analysis to work it out for us. ISA 505 also requires us to undertake external confirmations, third-party verification. So we normally do this at the planning stage where we send out confirmation secularizations, debtor secularization, so that the debtors could sign off and say that, yes, we owe the company this much. Now, under ISA 330, it doesn't really call upon us to do a secularization or third-party confirmation, but it is very important for us to follow through that there could be risk assessed. Okay. Now here, ISA 330 tells us that confirmation procedures will help us as auditors to obtain audit evidence with a high level of reliability, because we are getting the information from a third party, independent party, who is not related to us. Okay, so in the information gathered independently by the auditor from third-party sources actually is more reliable than what the management tells us. So it helps us to assess significant risk related to risk of material misstatements, whether due to fraud or error. So it is always important to send these independent confirmations to to vouch the receivables balances. Samples, of course, not everyone. So you deal with the significant balances. We require the permission of the clients. If they don't give us permission to go and obtain this confirmation from their debtors, ask why. Seek reasons, okay? But mostly they will allow you. There's been some poor response rates over time, but typically we've been told that listen, poor response rates, 5 to 10% is typical. But there are times that you get troubled with this debtor. Sometimes we send it to them independently, and they will call the clients for the client to tell them what to write. They don't want to be in the bad books of the client, because at the end of the day, your auditor will leave and they owe the client, and then the client, it becomes give and take. So you always want to play safe. So, but I mean, do your best as an auditor. We could also verify this in terms of the aged analysis, like I said, which will help us to create allowances for doubtful debts. And as part of our subsequent events review, we should look at receipts from customers after the year end. Any credit notes we have issued, or the clients have, I always say we, I speak like the client, okay? Because as an auditor, you identify yourself more with the client and it makes life easy. So consider the receipts, the cash, the checks, which the customers, the receivables have paid to the customer, to the client after the year end. Any credit notes issued by the company since the period end, check for those ones. And then any correspondence with customers, obtain them. The idea is that we want to ensure that majority of the balances are cleared within a suitable time frame of the period end. Anyone which is not cleared, we should make provision that we cannot retrieve it. So auditors, you could recommend that they should make allowances for bad debts. Bank balances, quite interesting. We always do this. So again, still under ISA 505, external confirmation, we could send directly to the banks for them to confirm the bank balances for the company. The banks do it swiftly. They do it swiftly, and it helps us a lot to identify whether there's something wrong with it. You also want to do bank reconciliation to confirm the cash balance or the cash ledger balances with the bank balance, and check whether bank reconciliations are done regularly, usually on monthly basis by a different person who is not, anyone doing the bank reconciliation should not be the custodian of the checkbooks, nor should he also be a signatory to the bank account, nor should he be going, I mean, clear-cut segregation of duties, over there. Remember your soap spam and try to plug them in. The client would always have to give you an authority note, an authority for the bank to release the information to them, because it's quite a sensitive one. And once again, the bank will certify the balances at the end of the accounting period, and additional information such as accrued charges and safe custody items. Now, there is a case you would have found in, we call it a wirecard fraud. If you look at your textbook, page 266 of the 12th edition of Mellichamp and Taylor's books. So the wirecard fraud relates to this huge, it's a German financial service, it's a very huge one. In the year 2019, Ernst & Young, EY, they refused to sign off the audited financial statement of Wirecard because there was 1.9 billion euros cash balance or sitting on their statement of financial position on their balance sheet. But the confirmation from the bank couldn't confirm that 1.9 billion euros existed. Now, that 1.9 billion actually constituted about 25% of the entire statement of financial position of Wirecard. So you could see it was so significant. 1/4 of the balance sheet balance, statement of financial position, is actually cash balance, which cannot be traced, 1.9 billion euros. So when they spoke to the directors said, well, these monies has been transferred out to 2 banks in the Philippines. And I think EY relied on the statement of the directors and then proceeded and signed off, which wasn't a good thing. Later on, do you know what happened? It turned out that that money did not exist. In fact, the two banks in Philippines confirmed that such monies have never hit their bank account. And the central bank in Philippines also confirmed that that 1.9 billion euros has not entered their monetary territory. Okay, so there are legal consequences if we don't do the good work, if we don't do our work well. So it is always important, like I said, ISA 330, auditor's response to assess rate, doesn't tell us to do these confirmations. Okay, but now, good enough, we have ISA what 505, which requires us to do that confirmation. And you have to do it in your own interest as a bank, as an auditor, so that you don't end up incurring auditor liabilities. Okay, so we end here. The same questions from Unit 8. The same questions are here. And then under chapter 15 of the core test, you find this detailed ACCA question on Megatron and Macedon, Megatron and Macedon. So try and review them, and then we will be good to go. One thing you would realize is that cash is also part of our assets, but we didn't look at it. I would want you to look at cash. And easily over here in cash, we always look at inherent risk of fraud. Sometimes people, because it is cash still, they dip their hands in it and take it. It's an impress system. So you'd always want to conduct a review of the operations of the cash system, especially the impress system, and check whether anyone who picks out cash or who takes cash to go and conduct any activity returns with a full report. Conduct surprise cash count on the float and check how regularly is it reimbursed. Also, realize that people could hard up. Some people may be hard up, say, come on, can you give me some £100? I'll pay you at the end of the month. So you always have the IOUs sitting on the impress system. Make sure these IOUs are highlighted and they are collected. They are recorded. Sometimes somebody will say, give me £100, and the person will not actually want you to record it because I said, I don't want the management to get to know. I'll pay you back. Okay. So we end here, friends, and then we'll take it in the next session. All the best in your studies, and speak to you soon. Bye.